Somebody took out this room. I think the vacancy rate in Manhattan skyrocketed. So thank you all for coming. In all seriousness, we've been looking forward to this event for the last 4 or 5 months, and I think, as everyone here probably now knows, we're constantly trying to find really interesting ways to connect our clients. I think that's always the most important thing for us. But and going forward, this is going to be a hard one to beat. Anytime you can get the top landlords in New York into the same room, which is quite frankly a feat in itself, and mix it together with the Bob and Peter effect here, I think it's always going to be a good recipe for a pretty awesome conversation. And I think the banter between these two guys over the last 3 or 4 weeks, just getting set up for this has been pretty fun. So hopefully it makes for an engaging hour. The reason why we were so excited about getting these two guys together in a room is not only do they have a pretty amazing history together, so from starting together, I think in the bullpen at Williams, maybe 25, 30 years ago, leading the charges.
He
was yelling at us.
He's buying us. He's buying us right now.
But yeah, I mean, it's a pretty amazing story, right? Starting together in the bullpen at Williams to now leading the charge at 2 of the top firms in the world. But these guys now have probably hundreds of millions of square feet of leasing behind them. But we think the interesting thing is, how amazing it is how focused they are on the future and really sort of leading the charge through this next wave of brokerage in commercial real estate. So that's one of the reasons, again, why we were just so excited to get these two guys together. And again, they're pumped to lead the conversation. We also have Paul Glickman here and Peter Turchin. So Nick, if you want to just give a little background.
So they brought their strong arms here. So any analytical questions, you can guess they're going to answer them. We do have a couple slides that collectively everybody worked on. So again, this is really meant to be a conversation. We want you guys to interact with everybody. We do have slides to kind of go through and add context to all the conversation. So they need no introductions. I think we should just get going and have some fun. So I'll be controlling the slideshow.
You get to be Vanna White?
Yeah, exactly. In terms of topics, this is what we want to cover. Most of this will probably email to you guys, but really market snapshot. So what are these guys seeing in the market? They're lucky enough to work with a lot of you guys, but also on the tenant side, what are they really seeing? Industry trends, sourcing and meeting demand, and then talking a little bit about new construction, right? So how does that affect the landscape? What do their clients think? All these different topics. So
we're ready to go. So just in terms of the context of the slides, we had a big shindig yesterday. I don't know how many of you all attended, but we neglected to cover the market from the CBRE side. So what we thought we'd do, even though this is supposed to be a conversation today, what we thought we'd do is just hit on some quick slides that we can do a Q&A on later, but it's really only 10 slides. We're not sitting there going to beat your brains out with these things, but we do want to try to just sort of set the context and talk about where the market's going, what tenants are up to, et cetera, et cetera. Right. Pete, you were going to lead the way, and Paul, you were going to try to chime in on the slides. So do you want to take a roll on these?
Sure, and just you guys can see the first slide, which basically just tracks asking rents in the 3 major markets: Midtown, Midtown South, and Downtown. Everyone knows that the big change that's happened in Midtown South and the growth. Depending on what econometric model you use, if the rates of growth increase, there is a big conversation. Maybe these guys can discuss it a little bit. Is could there be a possibility of Midtown South passing Midtown in terms of average asking rents? If you look at the recent trends and you look at the rate of growth, there's a possibility that that line can invert. So what we've seen historically, kind of the Midtown South, Downtown crisscrossing one another, is there possible now that Midtown South and Midtown crisscross one another?
So I don't think so, right? So I think that Midtown is alive and well. The Midtown market, it's a few 100 million square feet. So when you start getting into averages, that has a big impact on things. We track the trophy market, and now we're even tracking the super trophy market, right? And so, we're seeing, tremendous amount of transactions in the $100 range. We're seeing really for the first time in my 30 plus years, transactions of scale at $100 plus, few floors for $100 plus. So I think the Midtown market is just fine. And I think that the Midtown South market, as exciting as it is for millennials and the cool, great space, We'll bump into some issues. You know, some of the buildings physically don't lend themselves well for the density of today's tenants. Some of the buildings don't have the floor plates, and we're starting to see some of those tenants already looking into Midtown. So I wouldn't be afraid of
it's
Midtown.
It's a small tenant market, essentially. Outside of like 11 Mad, which was a great buy, and you guys did a super job on that. Outside of buildings like that, there's probably 3 buildings, 205th, some trophy buildings.
Right.
It's a small tenant market.
So maybe we can talk about the size of tenants. So let's go to slide 2, which we can work out. You guys talk about small tenant market, what type of industry. So for those who can't see, what this talks about is, you know, Manhattan, which a large part was finance, and the major tenant in the market is getting to be driven by other factors. So you have now media, law, and now we have the green, which is tech. You can see, as we took that look at what it is in Manhattan, it's 28% for finance, which is down from what it used to be. I'm very loud. They can all so if you look at it, you know, again, they're still the dominant tenant in Midtown. They're very much the dominant tenant in downtown. In Midtown South, tech is technically the dominant tenant. So how do you guys see, you know, the different tenant breakup in each individual market?
Well, I think it's great. I mean, the tech boom here is essential. I think the Cornell Technion University, the foresight of Bloomberg to try to get more program engineers here is all a wonderful thing. We've had a real rebound out of a tough recession that's really occurred without the financial service sector. But the financial service sector right now, and you guys as landlords, as you're tracking deals, I mean, that's where you want to be. You know, Bob's got UBS, we've got Deutsche Bank and HSBC, they're active. I think they'll make decisions next year. You see the activity at a 280 Park. You look at MetLife. You know, I think that the marketplace is again active in the financial service market. I think what's driving it is New York City is still the place where they can win the battle for talent. And although they might not necessarily be adding jobs, new jobs, they're definitely challenged by relocating jobs to the Carolinas, to Florida, to Texas, you know, where maybe a couple years ago they thought they can send 1,000 jobs out. They're coming back and finding they can only send a couple hundred jobs out, so the requirements are robust. Even someone like Deutsche Bank, which is struggling globally, you know, they're talking about closing South American businesses, but they would take a lot of the people that have real business there and relocate them to New York to run their South American businesses. So actually the New York requirements could get bigger. So I think New York still is going to be dependent on the financial service sector, but it's great that we now have other industry to help out.
That's actually a good thing.
Right, that's right.
So I have a little bit different spin on this. I mean, we just finished a repositioning with Citi, and actually Steve's in the room, right? We spent a couple of years doing that, and essentially Citi has gone from 8 million square feet in New York. Their net will be, after 111 Wall disappears, will be about 2.7 million in New York. And we're just finishing up a Jersey strategy for them, so they'll be taking a significant chunk of that space and moving it over to Jersey. Also JPMC, who's had expansion in certain areas, has literally made commitments now for almost 1.6 million square feet in Newport over the last 18 months, part of that due to the issues associated with the deal that we tried to strike at Hudson Yards. The city was relatively nonchalant about how they wanted to position this. They did not pursue it aggressively, and net, they pulled back and they started growing the uses over in Jersey. So while I agree with Peter, and by the way, without financial services, I'm in trouble. I got no business. I got to go work for John, showing space, and Peter.
Now we got a new pre-build program, Bob.
Yeah, super, I'm in.
3,000 foot units?
2,000 to 5,000, I'm ready to go.
So, I think to add to what Bob's saying is the paradigm shift that I've seen is the translation of those jobs haven't disappeared. So if cities,
That's right.
if there's a reduction in workforce, some of it's gone to Jersey. A lot of the other reduction in the workforce has translated itself into the small boutique hedge funds, the private equities, the spin-offs, you know, that are taking all of that expensive Plaza District space. They're not going out of business, they haven't retired. So I think you're still in the work.
No, and Bob's correct. I mean, all these requirements are getting 25, 30% more efficient, smaller.
No question.
But I kind of look at that as a saving grace, because all these companies are getting smaller and they are trying to find space that is attractive for talent. And they are really, by cutting their space needs per person, are able to sort of look at a plan that moves them to a better building. And that first month of stabilized rent in a new location can look a lot like the last month of a stabilized rent in an old location. And I see Jerry here, we moved Skadden into, Manhattan West. They went from 900,000 feet to 600,000 feet, right?
Heard they're looking for another 100 though.
Right, but they are.
That's a good thing.
Right. But.
Whoops. That's a good thing. Hey, I'm not, all right. Hey.
But,
terrific.
but the good thing about them is, that fueled the move, right? That enabled a partner there to say, hey, I vote yes, because, I can see into the future. And so I think there's a lot of balance here with getting smaller driving deals.
And what's funny? So Skadden, what a great deal, what a signature situation for the West Side. And I have to tell you, in, 1998, I was working with Peter's dad, actually, and we were trying to retain Skadden at 850,000 feet at 919 3rd. And we had asbestos, we had all the shit going on there that you couldn't believe. And we tried to strike a deal at, let's call it $37 a foot. The net was they couldn't get around repositioning 800,000 feet within the building and remove asbestos, et cetera. And they opted for the more expensive deal of $44 a foot at 4 Times Square. So they moved out. We were heartbroken, obviously. Turns around, Debevoise leases the space within 12 months at $55 a foot. Who knew? Just right? Who knew? And Skadden has been a groundbreaker. I mean, they've done it again. Right. They've done it twice. You got to love it. Just like Conde. Right. It's really, really terrific. Do you want to go to the new construction? We can touch on new construction for a little bit. Yeah.
Go ahead. So one of the first things I would say about the marketplace, and it's a perfect lead-in on the space size. So space sizes are getting smaller. We've added, I don't know, how many millions of square feet of new space, Peter? I mean, count on your fingers, what, 14, 15? About that. 14 million square feet of space. There has been some landlords who have talked about a 29% loss factor as opposed to a 27% loss factor. If that happens, old math, 2% times 400 million feet, that would add inventory to the marketplace. And then you got to start saying, well, how many jobs does it really take to fill up the gap? And are we really adding those jobs to the marketplace? So I think Bob's right. I mean, people are always going to go to the new buildings. I think all these new buildings are doing well. A lot of the first in these buildings did great deals. And they seem to be doing really well. I think, and Bob, you're involved with it. Hudson Yards related has been just a tremendous success story, right? Tremendous success story.
But an interesting dynamic, Peter, is that if you look at the 4.3 million square feet of new construction that has been committed to over at HY proper, probably 64% of that has been bought.
Right.
So the corporations are looking at it a little differently relative to, from an investment perspective, and relative to a 40-year amortization period on purchase prices of $1,300, $1,400, $1,500 a foot. The leases, I think it's suffice to say that we're all anxiously awaiting our first $90 plus lease in HY for a significant tenant right now. So, and I'm sure, Jerry, you feel the same way about that as well. And I think it's going to come, because I think it's going to gravitate toward that once the whole West Side is finished, because it's just unbelievable. But the interesting thing is, to get this off the ground, the majority of the space was bought.
How do they address growth in a situation when
you know what? You know what's funny? They really, we have the leases, L'Oreal and SAP and everybody else, all the brokers on the other side drove horrific bargains. We had to give up floors of 5 years and so on and so forth. You buy. It doesn't really work that way. So you're going to have to buy a little bit more than you probably need, and we'll see a lot of reshuffling going on, I am sure. Right. But right now, look, they're in for, if you look at the cost of new construction, and you spread it out over 40 years, not so bad from an occupancy cost standpoint. You just got to be prepared to do that. And I'm sure, Peter, you've seen, and Peter and Ed have seen that a lot of the financial firms up till the last year didn't want to hear about long-term commitments. Everybody's putting Band-Aids over things and renewing for 5 years and doing things of that nature. And that actually is changing right now. So people are stepping up, making long-term commitments. If you look at Citi, their commitment to 388, 390 is going to be well over $1.5 billion to rebuild their new headquarters. It's going to be absolutely state-of-the-art and spectacular. The folks at Morgan Stanley have made recent commitments to Paramount for 250,000 square feet. That involves all new build-out money. You know, that's new. That's not something that they would have done 2 years ago. I think you're seeing that with HSBC?
Well, I think that to get from point A to point B and get smaller and get more efficient does require a lot of capital. And so I think that that's the one thing that doesn't come out in the, you know, sort of the story when you read the comps, that, yeah, they went from 1 million square feet to 600,000 square feet, but they spent $1 billion.
Exactly.
Right, but I think that is definitely the way. But I think the real question is not whether these new buildings are going to do well, because I think it's evident that they will all do well. There might be some negotiation, as Bob said, but they're going to do well. The question is the buildings that they leave, right? Right, and the buildings that they leave, you know, how are they going to fare, right? And how are they going to be successful? And where's the market for them? And now we want to go to the slide.
That's what this slide is about. So the next question is really, right, you know, so we talk about all the benefits of new construction and what that means, but how do the existing buildings, because a lot of the people here have existing, how do they compete? What does the repositioning need to be? The old days, everyone, again, redid a lobby, would put some new stone out, and it would be a reposition. They paint something.
Be specific on how we're going to reposition 1285 when UBS moves out. And touche on 1211 if News Corp goes.
We've been talking about this for a long time. A long time we've been talking about that.
But I'm going to talk about, because obviously there's some things you can change and some you can't. But what does it mean for landlords in terms of repositioning? What does a reposition mean these days?
Well, you know, Bob mentioned my dad. So I grew up with the ultimate building operator. So I learned the business from the inside out. You know, the first thing that when someone says about repositioning a building, I think of is modern elevators, upgraded, you know, efficient, you know, zoned HVAC system. And it's a funny, stupid thing, but we all sit there at the end of these deals and try and figure it out. Shaft space, right? Can't do all the technology and get everything done without shaft space. Yes, and everyone's going to value the building from the curb, so the lobby and everything's got to look beautiful. One of the things that I think is optimistic about all this space is that it's really in the hands of pretty experienced, competent landlords who seem to have the capital and are willing to spend the capital in repositioning their buildings, whether it's, you know, 4 Times Square, whether it's buildings on Avenue of the Americas. We have Vornado's here. They did, you know, I think it was the sort of the poster child for it at 1290. So I'm optimistic that they can accomplish that and reposition the buildings. I'm not optimistic that we can get from point A to point B with all the space without a little bit of a challenge. I don't know, Bob, how you feel about that.
In terms of leasing up the second generation of the existing buildings. Yes. It's going to require an effort, and at the end of the day, you know, it's an interesting debate, and I'm sure a bunch of you in here are looking at or trying to bid on 1285 and 787. And the issue is, you know, Eastel's doing a great job. They're out there pitching, you know, $100 plus rents that supposedly UBS is going to pay. But the reality is that when you have a fair market value arbitration clause and you have a market that has, what do we have, like 5 million square feet coming available on Avenue of the Americas? Oh, there we go. Pete, your slide. That's your slide. Actually, you're going to do that slide. You know, the reality is that there's going to be a pricing moderation relative to what's going to happen on 6th Avenue, because this space is going to get leased, and it's going to get leased at a price. And most probably 5 or 6 million square feet isn't moving at $100 plus a foot, right? The reality is at 1271, they're going to do an anchor deal, whatever that number is. Probably won't be 100, could be wrong. Market may take off. You know, maybe Morgan Stanley needs another 1 million feet, but I don't think so. I mean, you're in there right now looking at HSBC, and it's kind of like, okay, I need to drive economics on this because you got overseas screaming and yelling on things, right? Correct?
Right. Well, look, I would just say that as it relates to UBS's fair market clause, there's a lot of time between now and then, right? And I think the market,
18 months.
In the market, the market could come and go.
He's the agent.
Bob and I went through this.
Making a point one in the room though.
By the way, the good news is we did this once before and we got a sign, right? So it wasn't without a few debates, but we did it once before.
Don't forget to report that I've done this, okay?
Right.
I need a couple of check marks.
I'm bullish on Avenue of the Americas, right? I'm bullish on it because it's a wide thoroughfare. I'm bullish on it because of the E and the F train. And I just think that when you talk about millennials, that's how they get to work, right? They get to work on the E and the F train. They live in Brooklyn. They live in Queens. I think it's great access. There's great landlords. There's great product. There'll be some challenges, right? But there's already a lot of good data and a lot of good things happening. Salesforce, right? Looking to step up and and replace the deal we did together too with MetLife and 1095. And so I think that there's a lot of opportunities for things to happen, and I think people are willing to pay up for the right solution, right? And it doesn't necessarily, like when I learned the business, mean the right solution is in this 5-block area. The right solution could be a building on Avenue of the Americas, or versus a building in Midtown South, versus a building at the World Trade Center, because people today who come to work at these companies live all over the city, and they're able to justify these different locations. And one building on the corner of Avenue of America and 47th Street will renovate, and the building across the street won't, and it's a completely different market, even though they're right across the street from each other. So I can't disagree with what Bob's saying, but I do think there's going to be some choppy results in there too, where there's going to be some higher deals and some deals that were aggressively negotiated.
Yeah, well, look, you look at the analytics. There's 6 million square feet potentially rolling on Avenue of the Americas. It absorbs about 800,000 or 900,000 feet historically per annum.
Right.
Right. So it's going to be a 3 to 5 year process.
And that's the key stat too.
Right? So
our
I'm hoping to get to you when the first deal gets done, not when the last deal gets done.
Right. So one of the things that this market's huge, right? It's 400 million feet, and our research, Tristan Ashby's here, and I sometimes get the numbers a little wrong, but we're absorbing on average some years 3-4 million feet. We've had some great years at 8 positive absorption, Tristan, right? Or on a 450 million base. So when a company like Sotheby's decides they want to sell their building on the Upper East Side, and it'll become, as sure as we're sitting here, some sort of medical use, right? And take 300,000 feet in Midtown. You could say 300,000 feet in a 400 million square foot market. What's the big deal? But that might be the difference in 2016 of a positive absorption year or not, right? Right. So those are the type of deals that we need to see more of. Or the Sony building, getting converted to another use. That helps where we're going. And I think
it sucks the absorption down,
it
right?
sucks the absorption down. And we're going to see more of those things because the city's changing. The values for residential, hotels, some of these other uses are making some of these other deal opportunities more viable.
So my premise at the end of the day is that Avenue of the Americas is going to trade at a discount to new construction, right, on the west side, if that's what the major tenants are looking for. The bigger the tenant, the more viable they are to look at the west side, or in fact downtown, which we should touch base on as well.
Yes.
And then you've got different pricing models for those. So if you look at the pricing model for downtown, Pete, you were there a long time. Would it be safe to say the pricing model for the new construction is between 73, 74 and 94?
Definitely in the 70s is the minimum bid for new construction.
Right. And Jerry, you guys are seeing what, 60s now? High 50s, low 60s for existing construction. So you've got and we got millions of square feet available down there, high quality product, a lot of activity down there. Capital markets are booming down there. So long story short, there's pricing moderation. If you look at the market, right, unless you have specific, and we touched briefly on this, the premium market, which if you look at premium market, we can make a presentation on the 30 million square feet in Midtown that's quote unquote premium buildings, and your average asking rent's $126 a foot. And John, I'm sure you've knocked off a couple of those. As a matter of fact, we're talking about a deal in that range right now for a smaller deal. So, but pricing moderation for the bigger users, when you look on Avenue of the Americas, right, that's a bulk use block, right? I mean, it's not, I mean, yes, you'll get individual floors. You're gonna have that moderation because you're gonna go over to the west side, you're gonna either look at a buy, you're gonna look at a lease there at whatever number that are, depending on the product, right? Tishman believes that, I believe that they wanna get in the triple figures to anchor the great site that they have on 34th and 10th, right? We know what HY is doing, we know what Jerry's doing on the great building that's going up at Midtown West, and we've got downtown. So there is a pricing moderation that goes till that product starts getting fully leased up. And I haven't even mentioned Jersey. Everybody's focused on Brooklyn, sorry, John, and Queens is coming along right now. Jersey's got great opportunity. I mean, we're over there now doing almost 700,000 feet of leasing. Let's call it in between $33 and $35 a foot. We think that that's going to start ratcheting up a little bit. I think, you know, Mitch Rudin taking over Matt Cali, he's got all sorts of plans. Hopefully he can execute on all these, but that is going to become as maybe not as desirable as Brooklyn, but damn close, because it's literally, all you got to do is take the PATH train across one stop.
Well, look, New Jersey's great. The incentives that, you know, are available or make the deals, you know,
grow New Jersey, baby.
Practically for free. But we just moved Knight Capital back from Jersey City to New York City to Brookfield Place because they just didn't feel like they can win the battle for talent, traders, research, those type of people. So that still needs to be
front office versus back office, right?
Brooklyn, you know, I've got my son, my two granddaughters, another son living in Brooklyn. I spend a lot of time there, and it's got a great vibe. It's got a hip vibe.
Brooklyn's Brooklyn, baby.
And I think the problem in Brooklyn right now might be that there's just not enough product that's ready and willing for some of these tenants. And maybe that could change with the Navy Yard because it's just a great location.
Well, Navy Yard, Industry Cities.
Industry City.
Right?
Question for both of you.
But just let me say downtown. I think downtown right now is overpriced. I think that a lot of people looked at the Brookfield success, right? When we took BNY CEO on a tour of the final choices, Jerry led us through Brookfield Place and the Hudson Eats was under construction, but you could see it finished. And, you know, he looked at me and said, you know, my people suffered down here since 9/11. And you know what? This is great that they can have this type of environment. And that was when the decision was made. When we were walking back to the office, we had some work to do, but that's when the decision was made. And I think a lot of the other landlords downtown tried to sort of see that success, started to look at a lot of graphs and listen to a lot of research people and said, you know, I'm raising my prices. And I think there's probably been a half a dozen deals, and I think the newest one will be ING, that have been lost. That the tenants that really seriously looked downtown, considered it thoroughly, and said, you know what, it's not enough for a price gap.
Well, ING's, you know, not for nothing, but I'm kind of involved in that.
Okay.
Yeah, so the pricing on the deal that they're currently looking at is not, there's not a huge gap. You're 100% correct. They've got a low-cost alternative.
They got a low-cost alternative.
If you want to call it that. I mean, it's not, you know.
Right.
So there wasn't enough of a gap to do that. But if you have let's say it's a 250,000 square foot tenant, it's UBS, and you want $190 a foot. I don't mean to keep coming back to the same thing. And I'm down at Larry's building at $75 a foot. That's going to make a material difference because the product is fantastic.
Right. Oh, fantastic product.
Right?
Fantastic product.
So, I mean, I think it all moves. It's just, you know, when you say overpriced, you're saying outside of the core, World Trade Center.
Overpriced is an alarming word, but, you know, I think that the bid and the ask, when I'm negotiating it for a tenant, I'm going to tell my tenant that we should do a lot better on the bid, on their ask and our take than we're going to do on a deal in Midtown on their ask and our take. I think there's more room to negotiate downtown because I think some of the buildings have followed are trying to sort of piggyback the success at Brookfield, and they might not have all of the amenities, the quality space, the new lobby.
It's a tale of two cities. It's a tale of two cities, right? You've got you know the product, and then you've got the periphery, right?
Exactly right.
Yeah.
So you guys both started talking about outer markets, Jersey, Long Island, City, Brooklyn. Historically, when I started the business in the mid-'80s, the equilibrium landlord-tenant at the negotiating table was 7 to 9%. We're sitting with a 10% vacancy rate, call it on average. We can debate that by a point either way by brokerage firm.
Yep.
How do you explain supply-demand pricing tied to the fact that we now have a 10% vacancy rate in Midtown, or Manhattan? Why is there going to be demand, to Jersey, to Queens, to Long Island, to Brooklyn, and downtown in that context? Where do we see that happening with such a high vacancy rate?
I can see the demand. I'll just answer for Jersey. The demand in Jersey is essentially op and techs and back office, right? And what's happened is a lot of the firms. I mean, look, you guys are living through it right now. I am sure, right, with
Right.
two of your major financial tenants. The demand, the issue is, I got ops and techs, I can move to grow New Jersey. I mean, just look what JPMC came out with $350 million. It paid for the building. They got the building for free from LeFrak at $320 million they purchased it for, to make a commitment to that building and make a long-term lease commitment, 10 years, to Jersey. So it's really driving price on functions that don't necessarily have to be in Manhattan. And that's really what's driving sort of Jersey. Brooklyn, I think, is more of a tech. Cool. Yeah. I think it's a different, I mean, right? You say that's
Well,
a different.
some of the tenants that are signing leases in Brooklyn wouldn't come to Manhattan if it was free, right? I mean, that's where they want to be. The 10% vacancy is a good point, because most of us in this room have been doing this a while.
What Bob's saying is reduce demand because
Right.
you're moving groups out, and workplace strategy is reducing
Small,
workforce.
but
That's a good topic to discuss with
10% vacancy when I started in the business was a bad number, right? 10% today, it's kind of like, I mean, this is a question for Hillary Clinton, I think, right? She would have fun with the stats on
You had to say that.
Right.
Why would you bring her up?
Because I think that this, the reason I say that,
Ruined
because
my whole morning.
there's probably about 4 or 5% of this vacancy that really hasn't really been in play. We've seen a lot of transactions, whether it's at 1290 where you put I'm not sure what hospital's in there, Ed. Columbia. There's more and more of these uses. We're the agent for One Columbus Circle. We've been dancing with a tenant for a couple 100,000 feet from the bottom up. That's not an office tenant. So there's this sort of part of this 10% that I don't think any of us are even focusing on.
Yeah.
And so the market does feel better at 10% than maybe it should. But it may change.
Okay, well, can I
have changed to be a new equilibrium.
Can I make a comment? Pete, would you just walk through, if I'm trying to fill up a fairly decent piece of space, would you walk through, this is the demand side, correct?
Demand, yeah.
Would you just walk through what happens, from, if I'm a 250,000 square foot user or not, from now through 20?
Well, right now, if you're a million square foot user, you don't exist right now in 2016.
I'm done.
You're done. There are none. So this is a chart that basically looks at
Expiries, correct?
Expirations by size.
Right.
So you see it in the bottom that the small tenants tend to be a little bit more consistent, obviously, because they wait till the end. But we know that larger tenants are kind of did things earlier. And one of the things that we've seen in the market run up is we've seen a lot of tenants make those commitments earlier. We've seen some 19 tenants. We've seen some 20
So let me ask you a
tenants.
question about the chart, because when I was looking at it last night, does this data take into account people who have lease expirations who are expiring in here but have already made commitments?
No. These are the expirations are taken out. So if you had a 17 expiration and you made a commitment,
So Skadden's expiration is in.
They made a commitment. So
They made a commitment.
They're not in that chart.
They're not in that chart.
They're not in that chart. They now have a new
Right, a new
lease
commitment.
expiration.
Right,
They're out. That chart.
Interesting.
They're in the longer
Thanks for
chart.
clearing that up. That's why he's doing it.
So these are the actual numbers that you can get a tenant to move. You can't get Skadden anymore. These are the after commitment. But you can see, right, you don't really get to these full years until, especially on the large tenant size, 19, 20, which I think you guys have mentioned a couple times.
So I have a question. So
Sure.
it's 20, UBS expires in 20, HSBC expires in 20. If they make a commitment in 16
Correct.
for 2 million square feet, that 7.7 of demand potentially drops down to 5.7.
Correct.
Right.
That's 100% correct.
Yep, okay.
Right. So this is, again, just the chart seeing where the demand goes, as you expect. Smaller demand tends to be more consistent. They tend to not be as early
They
in
make
the process.
decisions later, right?
Right, but we're finding that a lot of the bigger tenants have already made those commitments. So as it relates to blocks, you know, where you want, if you were a landlord, where you want to start positioning your buildings looks like, you know, that 19-20 range is where we started getting
No, and then,
full tenants.
and I think that CBRE, JL, all the firms would agree. You know, our pipeline is robust right now with tenants whose leases expire here and even further,
Yeah, right,
right?
exactly.
Because they have, you know, a lot of decisions to make. And in order to consider a new building in this city, you know, you got to be 5-6 years ahead of the curve in order to have the timing to get there.
Absolutely.
And so the activity, and I think the whole process today is so far ahead of schedule, which is an interesting factor in it. Do we want to go to the next slide, or?
Well, why don't we go to brokerage? Let's go to 13. Talk about brokerage a little bit, because I know you guys.
Yes.
You guys have the history of brokerage.
Here we go.
Well, I'll tell you this. In 1982, I was a summer intern at Williams Real Estate, and they put me at a desk, and I was like, my gosh, I don't fit in here, right? I was a baseball player, you know, getting B's in college, and
Nothing wrong with B's.
And I sat in front of a
Nothing wrong with B's. What the hell, man? Shit.
And this guy came in, right, and sat behind me with an egg sandwich on a roll and asked me if I wanted half of it, and it changed my whole perspective on business. That was 1982.
That was the beginning. That was the beginning of me. I gotta lose. Wait a minute. I gotta lose a little weight. That started 30 years ago. It's just the way it works.
And you had just met your wife then, commuting on the train, and it was all good. So that's where the business has changed radically. You know, in 1980s, if you were going to compete for a 50,000 square foot tenant, you know, they might have 10 firms that they could seriously interview. And if so-and-so at a firm had a locker next to the guy at a golf course, you were dead, right? He was getting the business. You know what? Today, if you have a locker next to the guy at the business, that's great. You'll get a chance to go meet him. But there's a big process for meeting him and getting that firm to hire you. You better have the platform. You better have the support services. You better have the experience at the issue at hand, right? And maybe know a few other people at the firm to win the business. But in 1980, that wasn't the case. And what's happened with the consolidation is it's just added to, you know, the ability for a client who buys our service in a place like New York to get exactly what they want. You know, when I talk to the people at JLL around the country, our fellow brokers, you know, they're still, if they have the locker next to the guy, they get the business in Phoenix and in Dallas. But in New York City, it doesn't work that way. And Bob, I'm sure you see it the exact same way.
I've got a little bit different spin on that, but yes, there's no question. So we see what's happening here, and it's interesting if you look in 1970, when I started in '79. Cross and Brown was the preeminent brokerage, and Steve, where's Steve Durrell's? Helmsley Spear was a preeminent brokerage operation really powerful, right? And then you look at as time's gone on, these firms, you know, adopted, bought, changed. C&W was a rising firm. ESG didn't exist when we started. When I started at Williams Real Estate, which turned into Colliers, right? We both started over there. Right. So you look at this morphosis that happened over the last 30 years, and now you've got the giants, JLL, CBRE. I assume Brett White is going to try his damnedest with C&W to put them in a category, and that really means on the global corporate services side. Right. So one of the issues that I see that needs to be managed a little bit is when you have the rise of global corporate services, you have really a process machine, right? It's a fixed margin, long-term contracts, Wall Street loves you, your stock price stays up, et cetera. Your stock price, our stock price, et cetera. We're local, right? This is so it's while we talk about sort of, you know, global reach, it's really local expertise that really carries the day. And we pitched it's really kind of a different pitch because you guys are and you own. You're not tenant rep. I mean, some of you may have certain tenant rep requirements, but pretty much it's ownership. If you look at that, it's a local business. It's who is in the offices. If you're getting Peter, terrific. You're getting Peter, you get Paul, you know the quantities you've got. The rise of the GCS really, I don't want to say takes the eye off the ball of entrepreneurship, but it's a push-pull within the giant corporations to maintain that entrepreneurialism while you have this sort of rise of the bureaucracy, which is necessary. I mean, CBRE with the Johnson Control purchase is 71,000 people. Right. I mean,
it's huge.
I mean,
so two comments. So first, Bob's right, the field has changed. When I started at JLL in September of 2002, and that year they finished up in tri-state New York with a big revenue of $7.2 million, right? This year we're tracking to do over $350 million in the same base. And so there is
pretty damn good.
It's an opportunity to change your market here if you do things the right way. But the one thing that you don't see as landlords, when we bring a tenant, maybe it's a big corporate tenant, is that it's getting very challenging because these corporations, JLL and CBRE competing, and I think we're pretty good at it, but you add some others who really don't have the platform, and the pricing that they're requiring is going to start to get to a point, it already has at our shop, where, you know what, they need a certain type of space, and the best person to handle the assignment is Paul Glickman, right? But at the type of fee that they're looking to get, it's not worth Paul Glickman's time. And then we need to put somebody else onto the project. And you, as a landlord, really, don't get the same thing. And them, as the tenant, don't get the same thing. And it's going to be interesting if this trend can continue in the next few years.
It's really deal management. We're not referring to the overrides that you guys are happy to pay us on the product that we represent you on. We're really referring to, at the end of the day, who's on the other side of the table. You're trying to get Steve TD done. And you know what happens if you had someone that really couldn't manage the corporate side. We'd have never got that thing done. I mean, it still took 2 years. Right. Still took 2 years. And the things we're working with some of the other major financial institutions. Because guess what? They're just like us relative to the bureaucracy. It is all, everybody's frustrated. When you're on the ownership side, you're extremely frustrated because decisions seem to take months. I mean, literally, we're working on a proposal now that should have been out, a month and a half ago? Still haven't got permission to send it out.
No, some of you in the room have gone through the HSBC confidentiality agreement for us to send you an RFP.
I don't think we got it done.
I
don't think we tried really.
And I love Ken Siegel. He's one of my dearest friends. He's the nicest person in the world and as smart as it gets. And I said to Ken, I'm done. Call me when you're finished with the confidentiality agreement. I mean, it's just ridiculous.
I don't want to hear it anymore.
It's just ridiculous. And that comes out of this sort of corporate, bureaucracy. Right.
So really the message to you all is just keep in the back of your mind, you have to manage what's on the other side a little bit as well. I mean, you have to be able to help. You have to be able to give, depending on the quality of the rep you have from the shops, whether it's JLL, C&W, or CBRE, you have to make a judgment call on how you manage that. Because there are certain people that can actually get certain difficult things done. There are others that are going to need your help in managing that. Right?
And the one thing too that, at any given time, right, we go on these presentations, Bob, myself, our companies, we got marketing people, research people, we have 10 prep meetings, and, right?
At least.
And, you got 60 minutes. Sometimes to make a $10 million fee, right? You got 60 minutes to win that person over. And sometimes that person really doesn't know the difference between someone who's really done it, someone who really has the services, really has the platform. So some of these other firms can sneak by, but actuarially speaking, if you look at what's going on, it's really falling to a few firms in this city. I would say 5 firms, generally are around the finish line.
It's
easy to see who they are, and I think that I don't think that's changing. I'm 54 years old. I hope to do this if I stay healthy for a long time. I don't think it's changing in my span.
I have a quick question, because I think everyone in this room has seen consolidation in some way, shape, or form across the brokerage industry. CB is an acquisition machine, right?
Yep.
I mean, that's in every core market. You guys have found a way to buy.
They got 10 investment
Number one
bankers
player.
that just work day in and day out in buying companies.
And Peter, you guys, I mean, Stahlback was a massive success.
Yes.
But it doesn't always work that way. I mean, I think the feedback that we hear, and we're lucky enough to work with everybody, is that like the DTZ Cushion merger, I think is not going as well as most people would have liked.
Think about it, it's a difficult situation. You have Cassidy Turley, DTZ, right, C&W, you have everybody ingrained in their particular operations. There's layoffs going on, there's job insecurity going on, there are old ways and new ways, and you've got a new head of the operation, and you've got a private equity firm that is calling the shots on this. Right. It's not easy. It's not easy. They're going to have a real, tough sledding for a year or two to get that organized.
I'm looking at Paul.
Yeah, it's true, Greg. It's true.
Paul.
Sorry.
This is a different deal because the leader doesn't have a team.
Right.
That's good. By the way, good point. Good point.
So I'm looking at
Every
Paul.
other big merger, there was a leader with a team.
Yeah, you're right. You're right.
So JLL's view has been, we've gone after everything. We made bids on, Massey NACO. We've looked around. It's, I sit on our executive committee, so I have an opportunity.
By the way, you've missed your opportunity to get the JCI patch on your shirt that they're going to hand out soon. So you know.
We looked at JCI, and our CEO is not Colin Dyer's a great guy. He's bright, and he kind of feels we're better off, other than the Stahlback, doing things like we've done in New York a few times. And I'm looking at Paul sitting here. When we brought in Paul and Mitch and their team, not only did we bring in a lot of clients and up our revenue, but the culture they brought. Say what you want, but they worked their ass off, right? And it just was like, and I work my ass off, right? And so it was like, look what you're doing to the other people that are here, right? It's such a positive for our organization. And and it takes a lot of time culturally to make people feel comfortable. We have a guy like Frank Doyle, who's a terrific agent, right? Was our go-to agency guy, and then we bring Paul in. And I said to people before we told Frank we were doing this, they're like, "How's Frank going to react to it?" I said, "How would you react to going into your kitchen at 12 o'clock at night to get a water, and somebody's making a grilled cheese sandwich in it, right?"
Ask for half.
Right?
Ask for half, and it's all done.
It's going to require a lot of thought and effort. But yet Frank and Paul came together and are working together, right? Because it was bite size, right? And some of these massive things that come together, it's hard to imagine how they're going to work through it. One of the things we try and stride ourselves on, and I know CB's damn good at it too, is we want to put all the risk at the beginning of a sales process. I want to know what my hardest part about winning this assignment. I want to know everybody who knows somebody there. I want to know all the data. So when I show up the first time, I'm as good as I can be. That requires trust, right? And brokers and trust are a tough word. So we sit in a room together, we're like, why should you go to the meeting? Why should I go to the meeting? Well, maybe the two of you should go. How are we going to do this? How are we going to compensate you on it? And I just don't know how you do that when you've been at Cushman or DTZ or something, and you don't really know the person that well. I think it's going to require a lot of work.
Yeah, well, when CBRE bought Insignia ESG, it was really a reverse takeover in New York, because New York is Insignia ESG. It still is, as far as I'm concerned. We just have a little management layer on top that's CBRE. Right. What's that?
You can call it ESG.
They took the screensaver off on me about 2 years ago. I had ESG in there.
Right.
John knows, he was in the middle of that.
Right.
Do we want to get, I know we're running out of time a little bit, do we want to get to a Q&A?
Let's do it. That was
Yeah, sorry to monopolize. Does anybody, Greg?
Yeah, you touched on it briefly, and I would like to hear a little bit more in terms of demographics and decision making as the millennials move into management and senior management jobs. That combination of a change in mentality combined with traditional selection process about transportation centers and amenities how do you see the decision process shifting? How will that impact Midtown? For example, particularly when you combine that with the Hudson Yards development or other new buildings that, you know, technically are more remote. There are no, very limited amenities around there, and there will be for quite some period of time. How do you see that whole dynamic working itself out?
So, but if you look at Hudson Yards, right, as an example, first of all, the two towers are full. It's 1.7 million, it's 2.6 million. They're full, they're done, they're committed, right? Jerry's gonna have his committed, that's 2 million. And then you've got the Western Yards, which is probably out in the 20s, and you've got Jerry's site on 34th. Moynihan's gonna flip, I think, maybe he'll build, who knows. But long story short, in the scope of when you look at Midtown, it's 225 million square feet, it's a peanut. And I think you are right to touch on the millennials, because the recruitment process for the front office is still, as far as I can see, is still robust for demand in New York. Midtown, downtown, depending on what people's flavors are and price points are. But there's no question the front office and the startup companies want to be in Manhattan. There's no doubt.
No doubt.
You know?
So one of the things I would say to your question, I think this is answering it, is, you know, for years, and you're all landlords, you had space and you had retail, and you always wanted to rent the office space and do the retail last. Maybe they get a bank and they want to put a branch or whatever, keep that flexibility. I think you got to rethink that. And if you look at 230 Park, they put that urban, I think it's called Urban Eats. Urban Eats.
Yep.
And I walked through there the other day, you know, and talk about generation gap. I mean, I wouldn't even know what to order, right? The food is just like, right? You know, I mean, but the place is buzzing, just buzzing. And I think that's going to have a positive impact for Rexon and leasing the building. And so my point is, as landlords, I think you got to start thinking about your buildings. How do I bring some vitality and energy to my building that'll be attractive for millennials, that they get that work-live balance?
Well,
you know,
look at Brookfield Place.
Look at Brookfield Place.
Story of doing
Exactly right. Exactly right.
You know, it's funny, we employ about 100 millennials, which is interesting, is that what they consider an amenity is very different than what you consider an amenity. We have a city bike stand on our corner, and they're like, this is the greatest building in the world. I'm like, I know it is. It's half the price of the other one. But you know, to them, that and having, you know, access to City Eats, which comes once every other month around the corner, they would much rather be close to that than, you know,
And have air conditioning.
or working veterans. Yeah. So
Do you guys have a view on the shelf life of that cool space millennial as they grow up and have kids and want to move, their wives want to move?
Yeah, they get to our age and they, like you said,
Exactly.
they need
All of a sudden,
AC,
Bench
they
City
need
isn't so cool
transportation,
anymore.
they need the cleaners down there, etc.
You don't know
It's good more.
We have a
the
suite.
coldest thing ever.
We have a suite at MSG, right? JLL. We have 12 seats in the suite. I think we had 60 requests for the Dead concert the other day, right? So I think people don't change, right? I mean, they continue to like what they like. And I think when I came into work and I sat in a little four-room, no window space with Bob and Brian Given.
Yeah, we had no windows.
No windows, right? You know, I aspired to have an office. That would be a great thing. A great
With
thing.
a window.
With a window, right? I don't think today's millennials give a damn about having an office. They want to get paid. They want to have a good job description. They want to have the right connectivity. You know, we're seeing more and more benching. I don't think this is going away. I think it's here to stay.
I started and spent 9 years as a broker, and Peter's right. That's all I wanted, right? I wanted the office with a window next to Riguardi, and that's all you think about. And then on the flip side, you start sitting in open seating, and you start to see how much more productive it is. I mean, we sit right next to each other, and quite frankly, we're the first ones, every time we run out of space, we're the first ones to give up our desks.
When we moved our space, 4 or 5 of the senior brokers came in and said, Pete, we can't have 2 windowed offices, right? Paul, you were there, right? We got to have 3 windowed offices for the senior people.
That sounds familiar. Remember that one?
And
4 windowed
offices. And so,
Bobby,
I said, fine, I'll give you, 5 of you guys, you'll get through it, but I'm taking a 2-windowed office, right? And like, come on, you can't. Long story short, we have 2 windowed offices. And Paul, you went from a big suite at C&W to 2 window offices.
But listen, he splurged. He spent $900. He bought a ping pong table. No, but I just want to add to what you guys are talking about, because I think your question is one about, it's not a trend. You're kind of asking a question, is this a trend tied to people? I think what you guys are saying is this is about productivity. It's about productivity in the workplace. It's about, we talk about it now at the Empire State Building. It's being able to go downstairs to your fitness center, have your conference center, have your Starbucks brought up to your desk. It's about not going out to lunch. If you went to Bloomberg's headquarters, they did this 15 years ago. There's food there. They don't want the people to leave. My niece works at Twitter. You stay past 7, you get your dinner, you get your cab ride home. It's driving productivity, and it's the live, work, play that generation likes because they're more productive. They don't have to go out and do a 2-hour lunch. They eat for 15 minutes. They get their workout in the morning. They can sneak out and do that in the middle of the day. And it's all tied then to labor and talent and recruitment and retention and, as you guys were saying, productivity. So I think that's here to stay.
No, I get all that, but my question is, beanbag chairs aren't about productivity. Bench seating when your debt's falling to 100 per square foot.
You know what? The beauty of Manhattan is a variety of people that look at different type of product. I mean, the only leasing I've done in Midtown South is I leased up 330 Hudson on behalf of Beacon and IC, right? Relative to what most of my clients need, I need big block space, I need pricing, I need efficiency, I need shaft space, thank you, Peter. Right? I need a lot of power, I need the HVAC to work, I need the elevators to be in great shape, right? Because I'm going to dense pack the floors, and I need generally big blocks of space. The hedge fund guys, what do they want? I want to be on Park Avenue. I'm going to Dave's the building, and I'm going to pay $200 a foot plus because I want to be on Park Avenue, and I want the state-of-the-art building, and I may have 350 square foot per person, but I don't give a shit.
So JPMC on November 1st eliminated voicemail.
Perfect.
Right?
Yep.
They're going to save $55 million a year because most of their employees don't ever check the voicemail. They really work off their cell phone, right? I'm sure you check your voicemail. I check my voicemail because we're from a different generation.
Your voicemail goes to your computer.
Right.
So, exactly.
And so things are changing, and I think that they're not. It's not going to go back. It's just not going to go back.
So guys, we've talked about densification, we've talked about new development, we've talked about a lot of sort of things that are potentially adding supply to the market. Bob, you talked a little bit about absorption. What does it really all mean over the next 3 or 4 years in terms of rent growth, midtown, downtown?
So
really for the major amount of space, not necessarily midtown south, which is only about 80 minutes.
Not to be simplistic, Andy, but it kind of reads like the stock market, right? Like it's a slow climb. We haven't even hit the peaks that we hit in 7 in some cases, right? Now, by the way, PS, again, if you take that 25 or 30 million square feet of premium market buildings, rents are up at 126, 127. Vacancy rates are probably down at 7%, right? But what's going to, you tell me what's going to happen with the job growth, because the job growth still hasn't been as robust. We haven't seen any pops like we saw at the end of the 90s and that we saw in, let's say, 2005 to 2007. We just haven't seen, there's been growth, but everybody's been holding back. They seem to be letting the strings up a little bit now. I think the stock market drop of a couple thousand points put a little scare into everybody relative to our sort of demand level. It's all dependent on job growth, and I really don't have an answer for that.
So job growth continues the way it is, sort of.
So the first thing I would say is next year's an election year. Tristan, election years typically.
Well, it breeds a lot of uncertainty. So the last 2 presidential cycles have not been good.
Not been good. And I would imagine that
for the economy.
For leasing activity.
For leasing activity. Sorry.
Right. For leasing activity. There is a lot of space. There's a lot of challenges. The first thing I would say is we have seen way more relocations than renewals over the last couple of years. I think there's a shot in the next couple of years that trend comes back a little bit because you guys are all smart. You see all the product coming out that you'll be competing with. And I think if you have a tenant and they want a couple of bucks more work and $1 off in this and a little bit of more of that, and the option is to let them go and compete in this market, I think a lot of landlords are going to say, I'm going to keep my tenant and reach a little bit. So I think we're going to see some more renewals in the marketplace. And I generally think that the next year or two will probably be flat to flat. But the one thing that we have not seen since before the financial market collapse is a spike. I mean, this recovery has happened without a spike.
Slow roll.
Slow roll.
Yep.
And if there's any improvement in the financial service sector, if the Googles or the Facebook, I think Facebook is trending to be a 1 million square foot tenant in this marketplace.
God bless.
Right? If those tenants start growing, we get a little change, whether it's a Clinton administration or a Republican administration, it's got to be better for Wall Street than the Obama administration's been, right? I think if we get a little help there,
anything's better.
anything's better. I think that you could
No government's better.
You could see yourself get a little bit of a pop, and that's how we're just going to, go in there and just hammer UBS on their renewal because we're going to have that pop.
You had to do that at the end. So I would say, I would also say a couple things. One is it's interesting because if tech is really only 7%, and we actually, a lot of the stuff we talk about millennials here is generated around the sort of tech. So what'll be interesting to see is if in fact that, we don't have another tech bust like we had in '99, if in fact they continue to grow, they can't fit in Midtown South anymore, right? So the size of the tenants will either drive them downtown, Midtown. I mean, it's just not, the West Side's, I mean, it's only got a couple million square feet left to develop. It's not really a monster player. So if that continues, that's actually going to be a good thing for the two major markets. I think another benchmark is if News Corp gets done and gets financed, you're talking about rents that they want in the top of the building of $120 a foot downtown. I don't know if that's going to happen, but the answer is it's a real benchmark. It's going to be great for you. There's no question about that. So I think there are certain things we can look at. I think we're working hard on One Vanderbilt. We think we're going to be very successful in that over the next 18 months, putting in a second anchor tenant past TD. I think that's going to be a new benchmark. It's going to match Levinson's building, but it's going to be a real 1.6 million square foot building, not more of a boutique building, which is new construction that Levinson's doing right now. All those things happen. Whether you guys decide to take on, I assume you're going to, 399 and really recreate and reinvent 399, I think that's going to be a statement as well. So we're optimistic, and I think this, look, it's New York, right? You put out great product. It's like MetLife. They went to the marketplace at 1095 on a sublease. We were kind of like, nothing's going to, it's great product. Guess what? I think they're going to be really successful, and they're going to get really surprising numbers for that product. Right? We're not, C&W is the ones driving the boat on for Met, and they're representing the quote-unquote potential tenants. But it's looking like a success show to me. So I think that's great.
So you guys want to spend a second on workplace strategy. Scott Reckler asked me the question. A couple other landlords have asked the same question, which is tied to Andy's question about demand and increased growth of employee, retention.
So you do me a favor?
Yeah.
When you come meet with Lenny Bedoin, our head of workplace strategy, you tell me what he's saying, and then I'll answer your question.
I'll tell you.
So one of the things,
I asked our
Okay, maybe you can answer.
No. So one of the things too that I'm look, basically to simplify it, I think the banks are at a spot. If you have 100 people in your department, you're going to get 80 seats. Sounds very simplistic, but that's kind of how it works, right? All the complicated workplace. But one of the things that we're seeing more and more is that working from home is generally seen as a failure, right? The interaction.
That's just when I was going to start this fucking year. I was taking Fridays off. What the hell, Pete? Jesus.
But working from home is a failure. So we're going to see more people come back. Right. But you know what?
That bingo.
CBRE, right? You have an office in California, right? In LA, there's people have unassigned seating, right? Unassigned seating.
It's the only office like that out of 320 offices.
Right, and you guys joked about 3 or 4 windows. I'll venture to say when you move the next time, it'll probably be about 2 windows. And I just think that that's just the nature.
Hey, Pete, when we move the next time, I ain't worried about it, brother. That's it.
The question is, how will that impact? Because for every move, the tenant who grows takes either the same space.
So I think it impacts the market in 2 ways, right? The first way we all know, people are using less space, and so we have an issue where how do we absorb the space? But it also, I think, helps the better buildings, because I think it helps people justify trading up to better space.
And paying more rent.
I can pay more rent. I'm using less space. My business is doing well. I don't have to have less of a run rate because I'm using 25% less space. I can have better space.
I think there's a message out here for you all as well, which is also with the dense packing, which you bring up right now. We can see a great result of dense packing was 270 Park Avenue, which JPMC spent $1 billion dense packing in their building, really dense packing it. Now they're de-densifying it because the actual infrastructure of the building can't handle the amount of dense packing they put into the building. So for the existing product that you have, you've just got to make sure that from a vertical access, HVAC standpoint, again, the shaft space, bathrooms, that you have the ability, if you're big game hunting, you need to have the ability to address all those issues.
Right. We have porters. JLL is really dense now, and we need more space. I mean, you know.
Are you going to interview?
No, but we have porters that clean the men's room 3 times a day.
Absolutely.
Right? Otherwise, it's just not acceptable. And you know, these are the details that people just don't think about.
No
right?
question.
Right.
No question.
We talked about millennials, we talked about workspace, working from home, and all this is sort of leading to, what are your thoughts on WeWork? As so many landlords in the building that probably either have missed tenant or at least they've looked at it. You've been in the business for a couple of decades, and now all of a sudden you see someone that takes millions of square feet in such a short amount of time.
So, you know, we've done some business at WeWork, right, you know, as agent in a few of our buildings, and we've represented them around town. And most recently, I've been in front of them a lot because JLL and CB did a contract with a competitor. It's a long story, trying to navigate that.
You don't want to hear the story.
You don't want to hear the story.
It's not an interesting story.
Right, navigate it a little bit.
Navigate, exactly.
Right. And so I've spent time with Adam Newman and Michael Gross. And I think that they have an impressive business model. It's more than just shared office space, right? Their technology apps, business-to-business opportunity for people through technology, I think are there. I think they got their eye on online brokerage, perhaps, right? They're doing a lot of different things. The question is, can their schedule of growth be accurately met? You know, in the finance markets, can they raise the capital to do that? Can they be efficient enough doing that? Can they be a credit worthy?
Can they get to the IPO line?
Can they get to the IPO line?
That's
right.
what they're looking to get.
That's what they're looking to do.
Absolutely.
But you know, walking through their space, it's not a bunch of young kids hanging out doing nothing. They're working in there, and there is a vibe. JP Morgan Chase is partnering with them. They're going to do conference centers and some shared space with them around their facilities. American Express.
It's in there, and it's not 18-year-olds. They actually have a business unit, a couple business units that they put in.
Right. I had a friend of mine who's involved in a professional team, a soccer team, not a big franchise, and they need a small amount of space. I sent him to WeWork. He's happy as can be. Right? He's got a few offices there. You know, there's a vibe. There's people. He doesn't have to build conference rooms. And he needs certain things. He's got the app for it. He travels a lot. He signs up to go to Chicago and, you know, for 3 hours have a room in Chicago. You know, so there's something there. The question is it too ambitious?
And it's not going to materially affect the demand of the other major corporations that are in Manhattan either. I mean, they're a couple million square feet right now. Right. So I don't see them as uh-oh, look out. Our buildings are going dark.
That's the other thing. People see the data while they want so much square footage. But if you represent Citibank or you represent, Deutsche Bank, when they're gearing to, put 4,000, 5,000, 6,000 people in a location, that's a few million square feet. It's not ridiculous the amount of space they need if they're signing up 16, 20, 30,000 people. They're going to need the amount of space that they're talking about.
Do we want, I know we're running short. Anybody else got questions? Because I know we want to try to cover.
You guys represent a lot of tenants with a lot of square footage. Any sublease inventory coming on the market?
Oh, that's a good question. Good question.
Off the top of my head, unless we're going to short-term sublease 1285, I think. No, sorry, Pete.
Right now, statistically, the numbers are historically low.
Yeah, I don't think we have anything in the pipeline.
Downtown, you can't even find sublease space if you tried. I mean, it's less than 2%.
I don't think there's a lot of midtown.
It's less than, I mean, downtown is less than 2%.
Let me ask you differently.
Yeah.
Are your tenants well occupied in the spaces that they lease? Or are they sitting on excess?
Right, that's a good question. So Barclays is a client of ours, right? And we have had some success subleasing for them. We subleased our space at 200 Park to MetLife, but it really wasn't a sublease because Tishman Speyer came in and then did
the buyout.
Did a buyout and did a direct deal. So I think that's a good example of how that really works. We have some excess space on Avenue of the Americas. We're thinking about getting rid of it. But the sublease market is historically low. When we started in the business, it was part of what we did.
And you can maybe engineer 1301 to be not sublease, but direct space, and you make a new commitment.
Make a new commitment. I think that a company today should have frictional vacancy in their portfolio. Should be under 10%. Maybe 5 or 6%.
I hear you. I think most of the big guys are about. They're not going to be lower. There's no way they're going to be lower.
There's no way they're going to be lower.
Most of them are between 12 and 15% because it's desks. It's 3 desks on one floor. It's 1 desk on another floor.
And it's hard to fill them.
Just another analogy, as Peter just said, we have been subleasing space for UBS over the last 3 years. So we're finished up at 299, just about. We have the last 2 floors going back to Fisher Brothers. Lo and behold, I get a call. What happens? Oh, we need the floor till 18. Right. So now that to me is just a microcosm of, okay, it's a reverse trend, right? First it was 500,000 square feet available. 2.5 years later, oh, let me get that 1 floor back. We needed a swing space. So that's interesting, and I think that is indicative. I mean, see, everybody's tight right now. There are no sublease. The big financial firms that I represent, we got no sublease space.
I agree.
But we do have a 10% vacancy in the portfolio though, because you just can't help it.
It's not a good story for a CRE to go into his boss. And last year he subleased the floor, and this year he needs to get it back at a higher price.
Right.
So
it's happened.
Right. So they're not going to move that fast on that. Right.
It's only going to cost $10 more. Than we had to
Right.
Any other, anybody? Okay, thanks. Appreciate it. We got everybody out on time?
Yeah.